This morning we have stocks moving just slightly lower, gold is bouncing back, the dollar remains firm, and oil continues its sink. The latest ISM Services PMI numbers disappointed, coming at 50.1 compared to the forecasted 51.5. This is also down from the previous statistic at 50.8. But quick recap, what is Services PMIs and why should you care? It's a survey of about 300 purchasing managers, which asks respondents to rate relative level of business conditions, things like employment, production, new orders, prices, supplier deliveries, and inventories. It's a leading indicator of economic health. Businesses react quickly to market conditions, and their purchasing managers hold perhaps the most current and relevant insight into the company's view of the economy. And so with last week's NFP report being a huge miss, and the Services PMI and manufacturing PMI numbers coming in soft this week, it's understandable that we may get a little uncertainty in this market. Doing a quick daily chart analysis here on the SPX, what we can see here is that we had a really strong run up in recent months, but of course that NFP report caused some fear in this market. We did get a bounce higher on Monday, a little bit of a rebound. Now the question is whether or not those gains can be held or if this Services PMI statistic could help to worsen concerns. I actually think that the path of least resistance, in my personal view for indices, is higher. However, the risk to reward does not look super attractive. What I mean by that is that things overall look really good. We're getting some really good corporate earnings, but the risk to reward of being long, in my view, is just not worth the squeeze. Because if we get some materially worsening in the economy and the Fed has to kind of rush in to save the day, rate cut, things like that, we could very well see a 5 to 10% plus correction in the SPX pretty quick. The risk to reward becomes more attractive for me if we were to get a pullback to levels like 61.25 on the SPX 500, and I could put a stop loss on this. Like, this trade makes more sense to me than trying to chase it up in these regions or even where it currently sits. I think we've just had a really good run in stocks ever since that big April sell-off, and so for me to get more interested, it would actually be more attractive to me to get a pullback to like 61.25 or even a deeper retracement down to like this 59.50, 59.30 level would be really attractive for longer term pullback swing trading opportunities. So that's really what I'm looking for when it comes to indices at this time. Moving on to gold, gold continues to be relatively range bound. However, there's been an impressive bounce back from these lows around the 32.60 area of support. And interestingly, some of this surprisingly weak economic data out of the United States has actually tilted the gold reading on the Edge Finder into the bullish territory for the first time in quite some time. If you know my strategy well, then you know very well that I am looking for the Edge Finder to give me a bullish or bearish confirmation with almost every trade that I'm taking. So gold getting a bullish rating gives me a stronger conviction to actually look for breakouts on it. So for example, if we were to see a break of this quadruple top, I do think that gold could start to look attractive on a breakout retest entry. But as I've said many times on the channel here recently, I'm definitely not really willing to wait around for gold. I'm not going to be trading inside of this range. I'm really going to be looking for, like I said, a breakout with some conviction, showing me that these previous levels of resistance where sellers came in strong, I'd like to see that break before making any moves myself. But just take a look at the weekly chart. Gold has been one of the most impressive performing assets in recent times. Of course, I think a large part of this comes from the idea that the dollar index continues to be very weak. And just remember that Friday NFP report really smashed the dollar down hard here, and we haven't really seen a huge recovery just yet. Fundamentally, we've been sharing a lot of research inside of the group on the dollar and other major currencies. If you're not already inside of the Telegram channel, I just wanted to make a quick reminder to consider joining us. Our team is putting out a lot of research completely for free, and it's free to join. We also do giveaways in here. We'll do Edge Finder giveaways periodically, things like that. So don't miss the chance to potentially enter a giveaway or get access to our free analysis we're sharing each and every day. The link to the Telegram channel is in the description down below. Checking on some of the currencies here, what you can see is that you have the euro dollar rejecting this level of resistance. In fact, we should go ahead and mark this as potential resistance here. I am a little bit more bullish on the euro than I am the dollar at this time. So if we were to get some sort of break and retest, this could actually be a possible long continuation play, but I am back in the camp of being more on the bullish side to euro dollar than bearish. And what I like to see is that retail sentiment when it comes to the euro is actually kind of back in the camp of bearish for the most part. We see 57% of retail positioning more on the short side of euro dollar, 52% on the pound dollar. So this one, kind of mixed. I would like to look at the euro dollar in a couple days. If you get a couple up days on the euro, it is likely that this number will get more extreme, as typically retail traders try to fade moves rather than join them. Some of the more extremes are things like the dollar Swiss franc, where retail traders are very bullish, and the Kiwi dollar, where retail traders are also very bullish. Same thing with the Australian dollar. Take a look at the Australian dollar against the US dollar, and this just looks, in my opinion, ripe for a little bit more squeeze to the downside, simply because now you see retail traders, as we just mentioned, getting really long on the Australian dollar. I would not be surprised if we see another leg lower, just kind of kick out some of the retail traders, or even lower from there could really get retail traders caught in the wrong side of a trend, as we see so frequently. I mean, just look at the dollar Swiss franc. Remember, I just mentioned retail traders are very bullish on this one. Well, they didn't just start getting bullish. Let me show you. We built some tools to track retail sentiment, but also to track it historically for backtesting purposes. And if you click on retail sentiment history and we select USD-CHF in the top right, you can see that retail traders have been overall net very long for a substantial period of time. Just look at this historical chart here. Going back multiple months, retail traders have been super bullish on the USD against the Swiss franc. Meanwhile, the chart continues to move lower and retail traders continue to fumble the bag on this one. Tracking retail sentiment on particular assets can be a really powerful tool, and especially an opportunistic one when you're looking for good risk to reward setups. If you want to try out the Edge Finder, I'll leave a link in the description down below to where you can sign up for our 30-day trial period. It is not a free trial, but there are some great ways that you can get 30 days of access and actually roll that into your final cost of the tool. If you want information about how our trials work, the link is in the description below. Taking a look at the put to call ratio, back to indices here for just a second, as well as risk sentiment in general in markets, we do see that there was kind of a spike in put demand here in recent times with that 1 or 2 day sell-off that we saw around the NFP report. Now risk sentiment is sort of moderating. People are back in the middle point. As yesterday, you had a big pop in stocks. Turning our focus to gold, you can see we're very much in the neutral camp. However, recently we did have some very high call demand. If this thing sways into the opposite direction, meaning people start to get more bearish on gold, that would be to me more of a bullish signal. And if we were to swing back to the downside, that would be a contrarian bearish signal. Another chart that kind of fell apart here for me was oil. I ended up taking a long position over here. Markets moved in my favor. I trailed stop loss right here and got knocked out of it on Friday. I'm no longer in the trade, but keeping an eye on oil. But part of the reason I was interested in oil was strong labor statistics. The Edge Finder picked up on the fact that we lost that with the NFP report, and I was trailed out of the trade, and I do not have an interest in rejoining the trade due to the lackluster economic data that we've gotten since when I initially took the trade. So again, we popped initially. I trailed my stop loss when it came out that NFP was actually very weak. The oil market dropped substantially, and I was able to take a profit before the drop continued. And despite gold's choppiness, we do still see some really nice overall trendiness to silver, the younger cousin or younger brother to gold. I don't know about younger, but the smaller, right? Because it's much less traded than gold, but still a very interesting precious metal and has a lot of momentum this year. We've seen some really nice performance out of silver. Believe it or not, silver is up over 30% here at the time of recording this in 2025 alone. And we can compare that to gold, which is pretty similar, but narrowly beating it as gold has had a 29% return this year. Bitcoin continues to roll over here a little bit this morning. Let's see if it comes back and how it responds to this area at 110,000. But you can actually see our risk assets, things like oil, NASDAQ, S&P, Bitcoin have mostly fallen off the Edge Finder, with NASDAQ being the only remaining clear bullish signal in terms of risk assets. A lot of our trade setups right now here on the Edge Finder top setups page are things like Euro Pound, Euro Aussie, NASDAQ, gold, Euro Dollar, and on the bearish side, we have the NZD, CHF, dollar yen, dollar Swiss, actually the UK stock market, interestingly enough, which makes sense. A lot of the UK data has been really soft here recently. The Australian dollar against the Japanese yen, the British pound against the dollar, Aussie Swiss, pound CAD, pound Kiwi, pound yen, pound Swiss. And why is the pound so weak here recently? Let's have a look. If I take a look at the UK economic heat map, it's pretty clear why the British pound is getting such a soft reading. Most of our indicators here, the GDP growth, manufacturing PMIs, services PMIs, retail sales, CPI, PPI, unemployment rate, and unemployment change are mostly suggesting bearishness for the UK economy. And in response, the British pound and the UK stock market are getting very negative impacted scores. The utility of the Edge Finder is that it automates this process and watches all of this data on your behalf so that you just kind of get an output reading from what the Edge Finder finds. So generally, the British pound is getting a weak reading across most other currencies. We can also see this prevalent in the economic surprise meter, where the British pound has one of the weakest scores on the list, the Australian dollar also coming in pretty weak recently. So when we look at things like the British pound against the US dollar, even though I'm not particularly bullish on the dollar, and I would actually rather trade a stronger currency against the British pound, but the pound dollar is a very popular currency pair. If we did get a pullback up into the 1.34 level, it does look a little bit more likely to me that we would get some downside from there. Things like pound yen, however, coming back down to a level of support. Let's see if we can break this, as you very well could get a slide here. In my personal view, that is a path of least resistance for the British pound against the Japanese yen. We hit multi-month long resistance at these levels. We've come down to support. Let's see how price reacts here, as this could be a falling point for further downside. The pound Swiss, like most Swiss pairs, continues to move lower and looks very weak. If you were to get a pop in this, I would say the path of least resistance would be to fade it and continue moving lower, in my personal opinion. And although the pair is very choppy, a move up into an upper extreme could actually be really interesting on things like pound New Zealand, which is one of the more extreme divergences. We have strength in the New Zealand dollar versus some weakness in the British pound. Same with the euro against the British pound. If we were to pull up that currency pair, I'd be looking for some possible pullback buys. Although I'm currently in a short position, I am looking to get out of my short positions and actually enter longs, especially if we were to get a pullback down to this area here. That could be, in my opinion, a good opportunity to start a long position on this one. The global economic surprise score here is still very much in the positive, however. So looking across currencies, we do see some relative strength in the global economy, more so than expected. And when I say expected, I'm talking about the analyst and economics community, which sets out all these sort of expectations for statistics like jobs reports, inflation data, etc. And so relative to forecasts, the overall economy, according to these 8 majors, is typically right now outperforming expectations. A lot of the concern, of course, around the trade war, tariffs, all that stuff has not really materially showed up yet. It might in the future, but right now economies seem to be holding up pretty well.
All right, man, let's make a bet. Whoever gets funded first, the other person has to pay him $100.
All right, I'm down.
Sweet. With my new fair value gap, triple witching timing strategy, you stand no chance.
Okay, I just got funded.
What? How? We just started.
With Maven's new instant funding program, you can get funded for just as little as 19 bucks. They offer some of the best industry pricing, fast payouts, and you can trade pretty much anything on their prop firm. If you'd like to check out Maven's instant funding program, the link and information can be found in the description below. You owe me $100, man.
Come on, man. That's not even fair.
So today we get services PMIs. On August 1st, which was last week, we had manufacturing PMIs. They came in lower than expected. So we were forecasting 49.5. The software shows we have 48 that came in. That was a negative surprise of minus 1.5. How does that impact the US dollar? Well, you don't have to sit here and think through it. The software does it automatically. US dollar impact, bearish. Stocks impact, bearish. We missed expectations. That was weak for the US dollar and for stocks, right? But remember, when it comes to fundamental analysis, this is why I say you can't do this all in your head. We can't just look at one thing. We have to look at GDP statistics, for example, which came in much better than expected. That's bullish for the dollar, bullish for stocks, right? We want to look at each individual key component. Do you know why we look at this? Why do we look at these statistics? Because the Fed looks at these statistics. This is what they use as their guide to whether or not they want to cut interest rates, hold interest rates, or hike them. Why do interest rates matter? Because they are the money printer. If the money printer is on, off, or just staying, quiet, that has huge implications on gold, currencies, commodities, indices, stocks, options. It is the ultimate driver of markets, is the money printer on, off. How do you predict that stuff? Well, you look at the data that guides the decision making. It's really not that hard once you start to understand why the markets move. Like once you get into fundamental analysis, you're like, oh yeah, this is what's moving the markets. It's not some handy dandy, retail trading strategy, liquidity gap, fair value thing. Like again, Nothing wrong with technical analysis, but to believe that that's what truly is like the whole market is around that. Look, it's like a tiny population of the world that cares about technical analysis, and it's everybody on planet Earth that cares about fundamental and macroeconomic data. You know how I know that? Everybody complains when the grocery store prices go up. That is fundamental analysis, right? When gas prices move around, people take note of that. That impacts everyone. Those are fundamental forces. That impacts consumer habits. It impacts employment statistics. It's the real world. That's what moves the markets. The real world is fundamental analysis. The fake world is, obsessing over technicals and not caring about any of the real stuff that moves the markets.
I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.